Tesla's earnings report for the second quarter of 2025 revealed sharp declines in both revenue and profitability, reflecting a combination of weaker vehicle demand, tighter margins, and increased investment in future-facing technologies. The company reported total revenue of approximately $22.5 billion, which represents a year-over-year decline of around 12%. This marks the steepest quarterly revenue drop Tesla has faced since its early growth years and reflects a broader slowdown in the global electric vehicle market. Net income for the quarter was approximately $1.2 billion, down from around $2.7 billion in Q2 of 2024. Earnings per share on a GAAP basis were around 34 cents, while non-GAAP EPS came in closer to 42 cents. Operating income fell to just under $1.6 billion, translating to an operating margin of around 7%, down significantly from nearly 11.5% a year ago. Tesla's once strong profitability has come under pressure due to persistent pricing cuts across multiple vehicle lines, higher input costs, and capital expenditures related to R&D. Total vehicle deliveries during the quarter were just over 466,000 units, which includes Model 3, Model Y, Model S, and Model X. Deliveries were down about 7% year-over-year and below Wall Street expectations. A key contributor to this decline was the partial shutdown of the Shanghai Gigafactory for production upgrades, as well as increased competition from Chinese automakers such as BYD and NIO, who continue to gain market share both in China and abroad. Tesla also faced tariff-related headwinds in Europe and logistical issues tied to scaling operations in its Berlin and Texas gigafactories. Automotive revenue accounted for approximately $18.1 billion, but gross margin in this segment declined to just over 16%, significantly lower than the 20% range that Tesla maintained throughout 2023. The company has slashed vehicle prices across multiple markets over the past 12 months to remain competitive, particularly in the face of aggressive price undercutting by BYD. While these price cuts have supported volume, they have heavily eroded margins. Additionally, the impact of elevated shipping costs, battery material inflation, and ramp costs for new production lines further contributed to profitability pressure. Tesla's regulatory credit revenue, once a key buffer for margins, fell to around $280 million from over $600 million in the same quarter last year. This decline reflects the growing compliance of other automakers with emissions targets and the maturing of the EV credit market. Despite these financial challenges, Tesla highlighted several strategic initiatives that management believes will drive future growth. Elon Musk confirmed that the highly anticipated Robotaxi platform is scheduled for a full reveal later in 2025, with limited pilot programs expected to begin in select US cities. Tesla is targeting a Level 4 autonomy capability, which would enable fully driverless operation under certain conditions. Musk also provided updates on Optimus, the humanoid robot project, stating that internal prototypes are now performing basic manufacturing tasks within Tesla facilities and that scaled commercialization could begin as early as 2027. The company reaffirmed its commitment to launching the next-generation compact electric vehicle, expected to be priced under $25,000. This vehicle, built on a new dedicated platform, is being designed with radically lower manufacturing costs, utilizing Tesla's advanced Geiger casting, structural battery packs, and simplified wiring systems. Management believes this car will significantly expand Tesla's addressable market and unlock demand in price-sensitive regions such as India, Southeast Asia, and parts of Latin America. In addition to automotive operations, Tesla's energy generation and storage segment continued to post strong growth. Revenue from the energy division rose 24% year-over-year to over $1.9 billion, driven by increasing sales of Megapacks and Powerwalls. The Megapack in particular has seen increased adoption by utilities for grid-scale energy storage projects. Tesla is in the process of expanding its Lathrop facility in California to boost Megapack output, and the company reported a record backlog for energy storage orders. Gross margins in the energy segment improved to roughly 14%, up from 11% a year ago, reflecting better production efficiency and scale. Free cash flow in the quarter came in at roughly $800 million, a drop from previous quarters but still positive. Tesla ended Q2 with over $26 billion in cash and cash equivalents on the balance sheet, giving it ample liquidity to continue investing in R&D, factory expansions, and new product development. During the earnings call, Musk struck a cautious but optimistic tone. He warned of rough quarters ahead due to ongoing macroeconomic uncertainty, intensifying competition, and geopolitical risks, but emphasized the company's long-term innovation pipeline as the core reason to stay invested. He also noted that while short-term financial performance is under pressure, Tesla's vertically integrated model and technological lead in AI, software, and battery development give it enduring advantages. Analyst reaction was mixed. Some remain bullish, citing Tesla's long-term vision, diversified revenue streams, and strong balance sheet. Others expressed concern about persistent margin erosion, slowing demand, and the increasing gap between Tesla's market valuation and its current earnings power. Several firms reduced their 12-month price targets, with revised estimates ranging from $220 to $285 per share, depending on assumptions around future product launches and macroeconomic recovery. Technical analysis indicates that Tesla shares are currently trading near their 200-day moving average, signaling a neutral to slightly bearish trend. The Relative Strength Index, or RSI, is hovering around 47, suggesting the stock is neither overbought nor oversold. Support levels are seen at $230 and $215, while resistance appears near $265. A sustained break above that could renew bullish momentum, especially if the Robotaxi platform is positively received later this year. In conclusion, Tesla's Q2 2025 earnings report highlights a pivotal period of transition. The company is navigating lower deliveries, tighter margins, and rising competition while investing aggressively in long-term innovation. Success will depend on execution in the second half of the year, particularly around the launch of next-generation products, cost control, and scaling autonomous and energy platforms. While near-term headwinds remain, Tesla's unmatched combination of software, AI, hardware integration, and ambitious product pipeline continues to differentiate it from traditional automakers and pure-play EV rivals. Investors must weigh the short-term earnings volatility against the company's potential to redefine global transportation and energy systems over the next decade.